Budget was unveiled, and I wanted to discuss some salient features of this budget. So, without further ado, let's jump into it. You can see that the growth rate in India is coming down. It is right now at 4.5%, and it was at 5.5% sometime in 2012, 2013. So there was a growth, and then it peaked at around 2017-16, and then it came down from there. This is called the Consumer Price Index (CPI) and Wholesale Price Index. It basically tells you what is the inflation looking like. And this is the FDI. So FDI has been fluctuating. Right now, the net FDI has gone down. And trends in deficit. So deficit is a factor of the gap between how much the country makes in terms of income versus the outflow in terms of expenditure. So you can see that the deficit was at 4.1% at the beginning of 2014-15, and it steadily went down from there to 3.4%, and then it has come back to 3.8% and 3.5%, and right now they've increased the deficit target to 3.8% again. And debt, you can see this is the debt that the government takes to finance its deficit. So debt has also gone up because the deficit has gone up. This is the money the government is taking from market to run its affairs. Tracking progress. So tracking progress is about the foreign reserve exchange, which has been growing, which is a good sign. Bank credits, we ignore that for that. We want to focus on this particular thing, which the Indian government says that India is the 5th largest economy in terms of GDP at US $1 trillion. So right now, as per the Indian government's claim, it is at $2.9 trillion, and it is behind US, China, Japan and Germany. So that's what is the current picture as per them. And I think they're closely behind, they closely followed by France and Britain, who are at 2.8. This is the budget. So if you look at the revenue, this is the revenue spent by the government in terms of crores. So this is 28 lakh crores is the upper limit. So it's spending up to 28 lakh crores in terms of revenue, but it is earning only close to 21 lakh crore of revenue. So this is a gap which they are going to have to fill, and this is a bad scene. If your revenues are less than your expenditure, if your revenues are if your revenues are less than your expenditure, that means you're basically borrowing money, and that trend is not a good trend for any economy. So, but since India is a growing economy, it's given some discount on that factor. Apart from the fact that that can be managed through growth. Capital expenditure is the amount that the government spends on capital expenditure, like roads and stuff like that. Then the government talks about budget at a glance. So where does this rupee come from? The budget says the rupee comes from several sources. So they get it from income tax, which is 17%. Then they get it from GST, which is 18%. They get it from corporate tax, which is 18%. They get it from non-tax revenue, 10%, borrowing and other liabilities, 20%, non-debt capital, 6%, union excise duty, 7%, and customs duty against 4%. So they have reduced the corporate tax lately, and this amount is going to go down. They have also reduced the income tax, so this amount is also going to go down. So the deficit is going to increase because of this particular thing. They're hoping some of that will be filled because of GST increase and because of the growth the economy will experience. And where does this money go to? Largely to state share and using interest payment. This is the deficit part. So if the government is having a deficit, it has to take some borrowings from the market, and the market will charge it, and the government has to pay 18% interest to the market. And 8% goes to defense, subsidiary takes away 6%, centrally sponsored schemes take 9%, pensions takes 6%, other expenditure 10%, central sector scheme 13%, finance commission and other transfers take 10%. So major share goes to state and interest payment. So this is not a good sign. You have to reduce the interest payment because this is wasteful money. This is money which could have been deployed in the rest of the other areas. And what are the tax proposals of the government? It says a concessional corporate tax of 15% to domestic companies in manufacturing and power sector. So anybody who's starting their new domestic operations, their government is going to charge only 15% as corporate tax. Tax concession of sovereign wealth fund for foreign government, for foreign government and other foreign investments. So if any other foreign investment funds like other pension funds from outside of India want to invest in the Indian market, this is not FDI. This is they want to invest in Indian companies and so on and so forth. Now, the FDI could be one of the routes, but they want to invest in India. They could get Indian government bonds basically, which is in the purview of fixed income. Then they will get a tax concession here. So this is attracting foreign funds into the debt market, not the equities market, because debt market is generally considered as a sticky market and equities is considered as a non-sticky market. You can take out money anytime from equities, but debt is something that you invest and then you stay in that market for a period of 10 years or whatever that debt period might be. They have also announced tax startup benefit by the way of deduction of 100% of the profits for startups. So I think for the first 5 years there's no tax for startups. Concessional rates for cooperative tax are also proposed for cooperative companies, which are basically unit holders. Like you would have some. Amul is one of those cooperatives which is run not by a corporation or the government, it is run by people. Turnover threshold of audit MSME increased. Extension of timeline pertaining to tax benefit and affordable housing. If they have increased the timeline on affordable housing, they had some 1 lakh given as an extended tax benefit there. And now they are also issuing registration numbers for charity institutions for easy compliance. They are also including a health cess in medical equipments which are going to be imported. So these are not the big tickets. The big tickets are going to be this one. So they are going to remove their dividend distribution tax, which was considered pretty much like a double taxation because you pay at the period of the company declaring the profit, because the company has already paid tax and then it is declaring the profit, and then it has to pay a dividend on that and again pay to the shareholders. Then it has to pay tax on that amount. So it's like double. And then if you are a high net worth individual, then you will have to pay that tax again because government charges a cess on that. So it's like triple taxation. So this has been removed, which is a good sign because now it means that dividends this has been removed and the onus has been moved to the consumer. So the corporates will just pay whatever dividend tax, dividend amount is there to your account, and it's your liability to pay that tax based on your tax bracket. They've also simplified the income tax regime as an option to the old regime. So there is no tax below 5%. There's a caveat here is that you should not avail for any of the government exemptions. There are a lot of exemptions which are there. We're not very clear at this point in time what exemptions have been removed, but pretty much if you not opt for any exemptions, you already have a house, you're not availing for housing loan and all of that, then you can avail the entire amount. So 5 lakhs and below, no tax. 5 lakhs to 7.5 10%. 7 to 10 lakhs it is 15%. 10 to 12 lakhs it is 20%. 12 to 15 lakhs it is 25%, and above 15 it's 30%. They've also simplified the GST return process, and the refund process is going to be fully automated. So this is really the gist of the union budget. And then there are some agriculture and irrigation and rural development schemes where they're going to be spending it, welfare, sanitation, education, blah blah. And they have also mentioned that the corporate tax rate, because of that, India becomes one of the most attractive regions for foreign companies to invest. So Thailand is the only other country which is having a lower taxation than India, and India has a lower taxation than all other countries. So China, Indonesia, Bangladesh, Japan, all of them have higher taxations than India. So it is going to be a favorable destination. That's the reason they're saying this. And they're going to spend all this money in road infrastructure and expanding the gas grid and so on and so forth. So that in sort of essence is the summary of the uh, union budget, just to get a broad understanding of what's going to happen. So again, dividend distribution tax has been removed, taxation brackets have been changed, and some concessional rate, which was not part of the tax for the budget, but it has been done any which ways, has been introduced. So that's the overall gist. Thank you very much.